And we are following developments on Wall Street this morning. The markets opened a little over 90 minutes ago. And as you can see, the Dow has dropped below 30,000 points. So we're going to bring in Javier David now to talk a little bit more about what's going on. He's the managing editor of business and markets at Axios. Always good to have you. So clearly this is a reaction to the Fed's raising interest rates. Tell us a little bit more about that.
We are in the midst of a really historic rout in government bonds, and that is really the story here. As much as people like to focus on stock markets, what we're really seeing here is a repricing of a couple of expectations. One, a Federal Reserve that's hell-bent on arresting inflation, even if it risks a recession. And two, the idea that the Fed at some point would come to the rescue of a market that has been kind of upended by this idea that inflation and the fight against inflation could soften if, in fact, the economy softens. The Fed's made it very clear that they're serious about this. And markets are kind of walking back this idea that at some point we could, see lower rates or the Fed pull back a little bit on the throttle, and they're not going to do that anytime soon.
So what's driving this volatility? I mean, typically in the past, recessions have come about because of fundamentals. Markets either get bid up too high and people over-speculate on them, and you see that the over-speculation doesn't match the fundamentals of the companies that people are looking to invest in. We're not seeing that right now. I mean, many companies, although the inflation has hurt everybody, not just people, but also companies as well, manufacturing companies, retail companies, travel companies. But I wonder if the fundamentals are as weak as the numbers show.
The fundamentals are not as weak, but they are starting to weaken. And I think that some of the news that we've seen out of corporate America, particularly with FedEx, which is kind of an economic bellwether, they had a really gloomy outlook. They really surprised the markets with how aggressively they warned that things were rapidly deteriorating. And I think that the markets and the economy in general are starting to price in the idea that, we're heading toward a softening. And while people are reluctant to use the word recession or declare a recession, it's becoming very clear that elements of the economy are starting to reflect significant weakness. And one of the bellwethers, I think, that are most interesting to watch is the price of oil. Oil for a very long time was very high. We're down, I think, maybe 2-3% on the day. Oil markets are starting to sort of reflect the idea that demand isn't going to be there the way that we thought. Now, that's good for gas prices, but on the other hand, the demand sort of destruction idea is consonant with the fact that an economy is either weakening or, in the worst case, heading toward a harder landing recession type of conditions.
So when we hear the word recession, the reason why it scares people is because we automatically think, job losses, that people are going to lose their jobs. But we're right now dealing in an environment where there are a number of job vacancies. So can you, what's the phrase, square the circle for me?
Yeah.
How do those two make sense?
Square. Circling the square. Yeah, I mean, for now, the jobs market remains very firm. People are continuing to see higher pay, or they're getting more money in their paychecks, and that's a good thing. But this is sort of where we are in the jobs cycle is not necessarily comfortable. The Fed is not necessarily comfortable with it. They want to bring some of this down. That is going to entail, and one of the reasons why the market is so addled right now is the Wednesday's Fed decision telegraphed higher interest rates and a higher unemployment rate. The sort of imputing is that they're going to see, or we are going to see as a whole, higher levels of unemployment.
And the other thing that we heard was that we can expect another interest rate hike at least before the end of the year, which is surprising to me because I'm like, we don't have very many months before the end of the year. And also that we wouldn't be seeing a cut until at least 2024. I'm going to tap into your sort of history here. I mean, how many interest rate hikes does it typically take before we can rein in a hot economy?
Well, the interesting thing is Bank of America put out some data earlier this week, and they basically said that whenever an advanced economy sees inflation above 5%, it normally takes about a decade to get it back to 2%. So you're talking about a tremendous amount. I mean, if the Fed is serious, and we have no reason to believe that they're not, a lot of sort of tightening. And we haven't even scratched the surface of the quantitative tightening, which is their effort to reduce the balance sheet. And they're allowing a bunch of debt to sort of roll over. That's putting upward pressure on interest rates as well in the bond market. But the bottom line here is it's going to take a very long time for inflation to normalize. We're not going to see this happen next year. Right. And so even if the economy is continuing to slow down and even skids into recession, there's a very real chance that interest rates will continue to rise.
Yeah, we're a long way from 2% inflation.
That's right.
All right, Javier David, thank you very much.
Thanks.